Well, good morning, everyone. I want to talk to you today about year-end tax planning. I know we've had this conversation in the past once or twice, but I want to talk about it again and get more specific on this part of the conversation related to one of the big mistakes I see people make at the end of the year is they come in, they've made money during the year, and they want to spend a bunch of money so they don't have to pay any taxes. And that's great, and we all like not paying taxes or minimizing our tax liability, and I am all in favor of doing that, especially minimizing your tax liability. But I want to make sure everybody understands that when you calculate your taxes at the end of the year, you take your taxable income and you multiply it by a tax rate. And the tax rates vary based upon what your income is. So basically, the more money that you make, the more you pay in taxes. So, there's actually, whether you're single, whether you're married filing joint, separate, head of household, there's several different tax rates. And so as your income moves up, you pay a higher and higher tax rate on that higher income. So let me illustrate a point. Let's say you have a profit in your business of, let's say, $250,000 this year. And that we'll just keep it simple, that's your taxable income. So you're gonna pay, if you're married, part of that income is gonna be taxed at 10%, part's gonna be taxed at 12%, part's gonna be taxed at 22%, and part at 24%. So if you're coming in to see your accountant, seeing me at the end of the year, and before the end of the year actually, so we can actually do some planning, it's important to keep in mind that you're paying 24% tax on quite a bit of that $250,000, but not all of it are you paying 24% tax on. Part you're paying, here again, part 10, part 12, and part 22. So as I talk to clients at the end of the year about year-end tax planning, I want to make sure that we're spending money wisely. We're not just spending money just to save taxes. We want to make sure that we spend money to more important than saving taxes is the fact that we're spending money wisely, and the money we're spending is actually going to make us money in our business, this year and in future years. So if you were to come in and see us at the end of the year and you're like, hey, what can I do to save some money on my taxes? We're like, well, what do you need to buy this year? Do you need more equipment in your business? And let's just say you really needed about, let's say, $30,000 worth of equipment in new equipment or new purchases going forward. So if you spend $30,000 and you're in the 24% bracket, you're going to save roughly $7,500 in taxes. So you spent 30, you save $7,500 in taxes, you still are out net $22,500. And that's the point I want to make. If you're going, it's not wise from a, let's say, building equity standpoint, just to save money, just to spend money to get your taxable income down into the 10 or 12% bracket, because at that point, if you really needed to only spend $30,000 on new equipment or new purchases in your business during the year, but you spend $150,000, you basically spent money that you really didn't need to spend. You're probably not going to get the return. So keep that in mind. So as you're doing your year-end tax planning, thinking about your year-end tax planning, you want to make sure that, yes, if you need to spend money, let's definitely spend the money, but don't overspend just to save money on taxes, because even if you're in the top tax rate of 37%, you're still out 63 cents if you're spending money on things that you don't really need in your business. So it's important when you do year-end tax planning to know where you're at, what tax brackets you're in, and then calculate, hey, if I spend 30, if I spend 50, if I spend $100,000 on new equipment this year to save taxes, what am I actually going to be saving? And that, let's say that number's, 15, 18, $20,000, but you spend $100,000, you're still out $80,000. So it's one of the, here again, big misconceptions I get constantly when new clients come in is, hey, I need to get my income down to zero by the end of the year if I pay any taxes. And if you need to spend the money because you need the equipment, yes, let's do it. Or you may want to break it up over 2 years. So just keep that in mind. That's one of the big misconceptions I see people doing is they don't think about not just taxes, but what that expenditure is doing to their overall net worth. So if you have a CPA or an accountant, please get with them before the end of the year, long before the end of the year. If you don't have a CPA or you're not unhappy with your CPA, please come see us here at Sunco CPA Group.